You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 29th of October 2024, and I'm joined today by my co-host, John McEwen. In this week's episode, we'll be discussing Bunzl, Unilever, NatWest Group, Reckitt Benckiser, Barclays, and Coca-Cola. John, should I start us off with Bunzl? I don't think it's a debut. I sort of vaguely recall we might have covered it,
I
although
think, once
I have no
before.
recollection.
No, it's a memorable company, isn't it?
Yeah, so we'll dive back in, we think. So, Bunzl, for anyone who's not familiar, it's a specialist international distribution and services company, and it operates in North America, continental Europe, UK, and Ireland, and it also has a rest of the world segment. It provides distribution services across 33 countries and supplies a range of non-food products, which include grocery, cleaning, hygiene, food service, retail, safety, healthcare, and others. And non-food consumables include, must do packaging as well. So its non-food consumables include food packaging, disposable tableware, guest amenities, catering equipment, agricultural supplies, and others. So they have come out with a Q3 trading statement, and revenue grew by 5.4%, ignoring exchange rate movements, and a 6.8% contribution from acquisitions more than offset the 1.2% underlying revenue decline. And that's an improvement from the 4.9% decline seen in the first half. This was helped by an improved performance in the US food service redistribution business. Bunzl continues to expect a small reduction in underlying revenue over the full year, but also a strong increase in underlying operating profit. Since the first half results, Bunzl's completed 4 bolt-on acquisitions and repurchased 100 million of shares under its 250 million buyback program. So Bunzl is made up of around 150 basically different distribution businesses, and most of the growth has been coming from acquisitions. So in the past 20 years, Bunzl's grown at a compounded annual growth rate of 9% a year. However, 2/3 of that has come from acquisitions. And they think there's plenty of opportunity because the market they're in is very fragmented and has quite good margins. In the first half, they had already committed 650 million to acquisitions, and this exceeds their previous high from 2017 following further acquisitions in this quarter. And management's committed to spend at least 700 million on acquisitions in each of the next 3 years where opportunities are available. In terms of the valuation, the business trades at a forward P of 17.4, and that compares to a 10-year average of 18.1. Prospective dividend yield is 2.2%, and that compares to a 10-year average of 2.2%. So it's basically in line with the 10-year averages. My view is, well, as mentioned, I think we covered this business before, but I don't remember it. Having gone back in, I think I can see why it wasn't that memorable. It's not the most glamorous industry, although that's not necessarily a problem. But I think for me, where the analysis would stop if I was prepared to overlook the industry, which I'm not sure I would be, because I don't really like these fragmented industries where people tell you there's loads of opportunity, but then you look and think, well, maybe there's a reason why it's so fragmented. So, for example, Halford springs to mind. But I just think I don't particularly like it when they're buying growth. However, there are firms that do this and do it very well. So, for example, Gamma Communications, which we've covered a lot in the past. However, the underlying revenue is declining. And if it wasn't buying this growth, it would actually be a declining business. And I just kind of think I'd rather see them focus on stopping the core business declining rather than just buying more businesses to cover it up, even if they're getting those businesses at good prices. So, yeah, for me, I just wouldn't be interested in a business that's declining when you strip out the acquisitions. What about you, John?
Yeah, no, I'd agree with your analysis there. And I just don't think the industry as a whole is very attractive. And it's not that shares aren't cheap either. So I think for all of those reasons, it wouldn't be one that I would look further at again.
Should we move on to a business that we do like then?
Oh, yes. So it's probably my favorite company, Unilever. They have their Q3 trading statement out with reported third quarter revenue of 15.2 billion euros, reflecting underlying sales growth of 4.5%, which was ahead of market expectations. This was driven by a 3.6% higher volumes and 0.9% contribution from price increases. The group's largest brands drove the performance, which was led by Dove, Liquid IV, Comfort, and Magnum. All business divisions reported underlying sales growth, with the ice cream division growing at the fastest pace, up 9.8%. Full year underlying sales growth expectations have been maintained at between 3 and 5%, and underlying operating margins are still expected to be in excess of 18%. A quarterly dividend of 43 cents a share was raised by 3%, and a share buyback programme of €800 million began in September and is expected to complete by December this year. And the shares were up around 2% in early trading. In terms of valuation, Unilever has a market cap of €118 billion and trades at 18.5 times forward earnings, compared with a 10-year average of 19.3, with a prospective dividend yield of 3.4%. I thought these results were good, and it was certainly better than Nestlé that we covered last week. I suppose one thing to say about Unilever is, yes, we've seen over the last few quarters the turnaround. The new chief executive does seem to be going in the right direction. Although historically, if you compare it with over the last few years with Nestlé, they have significantly outperformed Unilever. But the turnaround is taking shape. It looks like it's a much healthier company now. I suppose you would argue that that's reflected in the valuation now. I think we could think back a few years and it was trading at about 15, 16 times forward earnings. Now we're seeing it, creeping up 18.5 times. It's interesting with the ice cream business, which they are planning on spinning off on the basis that the margins are smaller with all the costs that are associated with keeping ice cream. I think they've got some fantastic brands. They're focusing on those core brands, the so-called power brands. And again, I'm optimistic for Unilever over the next 5 years. I'm glad I've held onto the shares and reinvested the dividends. I think it's a fantastic company. Those brands are incredible, and it's been probably underinvestment and focused on the wrong things over the last few years that's led Unilever to lag behind. But I think it's picking up now. And I know, Sam, you're probably going to say that 3 to 5% is not a lot for 18.5 times earnings. However, I think that it's the trajectory that we're looking at now over the next few years that I'm much more optimistic about.
I think they've done very well in the last couple of years. I think that's now reflected in the price, but you had chances to buy it a lot lower in the time we've been covering it. I think in terms of the price, 18.5 times earnings is not cheap for this business. However, we've seen it at 17 times, and that was when the earnings were quite a bit lower and the growth wasn't as good, because it's at about 48 quid a share now, and we've covered it at 40 quid a share in the last few years, and that's been at about 17 times earnings. So I think they have done a very good job with the earnings, actually. I think the growth is decent, but it's more, like you say, the trajectory that they're on. We've covered this quarter after quarter or half after half, and Nestlé's consistently put the better numbers up. And I know Nestlé started to wobble, but the fact that Unilever hasn't wobbled with it, I think is really a testament to how the management are doing. Because I think a few years ago, if Nestlé was doing work badly, Unilever would be doing worse. That was how it always felt. And that's no longer the case. I think they've got some fantastic brands. The only real criticism, because actually I'm not too bothered about the valuation. I think, would I rather pay 18 times for Unilever or 15 times for PZ Cussons? It's like, well, it's a no-brainer. You'd pay up for Unilever. You look at Reckitt, I don't think they have as strong brands. I'd rather pay up for Unilever. The only one really, if you exclude sort of the Pepsis and the Cokes, the only one really I'd consider instead would be Nestlé. And Unilever now, in the last sort of 6-12 months, has actually started to put up better numbers than Nestlé. I think there's a lot of potential in those brands, and I think those brands have been stagnant for quite a long time. So I think there's still quite a decent amount of growth ahead of it, actually. My only criticism would be, I think they've also got some excellent ice cream brands, and I don't think they should be spinning them out. I think they're excellent brands. They might be lower margin, but it's the highest growth division in the current half. I just don't think it's something they should be so keen to get rid of. When you look at the brands they've basically got the UK ice cream market locked up, and that must be the same in quite a few other countries. So I'd probably hang on to it, and if I was a shareholder, I probably wouldn't be selling my shares of it once it's been spun out. So yeah.
On to our next company then, Sam. NatWest.
Yeah. So NatWest, it obviously needs no introduction. We have covered it before. They have come out of a third quarter trading statement, and they've reported third quarter income of 3.7 billion, which was up 7.3%. And that was driven by lending and deposit growth and margin expansion. Net interest margin rose from 2.05% to 2.18%, and that's above the consensus of 2.1%. Pre-tax operating profit of 1.7 billion was up 26%, and that was driven by the top line growth and a 5.3% drop in operating costs. Impairments of 245 million were up 7% and above consensus, though default rates remained low. The group's CET1 ratio, which is a measure of financial strength for banks, was 13.9% at the period end, and that's within the 13 to 14% target range. Full year guidance has been upgraded, and they're now expecting net interest income of 14.4 billion, and that's up from 14 billion previously. And the shares were up 3.8% following the announcement. In terms of valuation, the business trades at a forward price to book of 0.84, and that compares to a 10-year average of 0.62. Has a prospective dividend yield of 5.2%, and that compares to a 10-year average of 4.4%. And the business currently trades at a PE of about 7.5. I think in terms of valuation, I think 7.5 is pretty reasonable. However, this is a cyclical business. My issue, well, firstly, it's a bank, so it's too complicated. I don't understand these liquidity ratios and the CET1 ratios, and it gets a bit too difficult for me. However, I view this as a very cyclical business, and I think I view it more as a play on interest rates. And I've got no idea what they're going to do. You could tell me exactly what the economy is going to do for the next 5 years. I'd probably still get interest rates wrong. And I do wonder as well now, I'm just speculating here, but we've seen taxes on excess profits for energy companies. Banking's not that popular a sector either. And I think if you've got a government looking to target businesses and types of businesses that are maybe doing well in a higher interest environment, even though they've struggled for years and years with low interest rates, it wouldn't surprise me if at some point someone comes in with an excess profits tax. I really think that seems to be the direction that we seem to be heading in. And I'll not go into the politics of that, but that would actually probably be a concern now. And I don't think I've ever said that previously, but I think I just would worry about that as well. So for a range of reasons, I just wouldn't be interested in owning a UK bank. What about you, John?
Well, I do actually happen to own NatWest, so it's difficult. I think it's part of my portfolio that I consider the sort of the legacy part, where I did have a bank which was Lloyd's, and I sold that and bought NatWest a few years ago. I think this was probably late 2020, and I actually offset the loss of Lloyd's and bought something that was very similar. I mean, it's the bigger of, well, not the bigger, but the one that had a large percentage of state ownership. I think Lloyd's had gone fully private by that point. The state sold all the shares, whereas NatWest was that other one that was the other big one that was bailed out in the UK in 2008. I do find the banks very difficult to understand as well. I don't think I would choose one now. I haven't touched NatWest since then, and I think it's probably more than doubled, and it's been paying out some very, very chunky dividends. I think it's just been where I got the shares after the pandemic, and when you have interest rates rock bottom, and then the hike that we've seen. And then obviously the bank's doing very, very well out of that. I thought these results were good. I think the valuation is probably fair enough. I haven't really decided what to do with my NatWest shares, to be honest, but I'd largely be in the same boat as you. It wouldn't be a stock that I'd naturally be attracted to now. I think I do have some biases there, just in the sense that it's very nice to see when it's up more than 100%. And it's in an ISA AFA as well, so it's been paid. Those chunky dividends haven't been subject to tax. But no, I don't think I would go in and buy it today. No, that's where I'd probably leave it. And the too hard pile, it would certainly come into that too.
In that case, shall we move on to our second consumer goods company of the week?
Yeah, and again, much, much easier to understand. So it's Reckitt Benckiser. It's a company that I used to own and I sold last year. They had the Q3 trading statement out. And for reference, I mean, we have covered it a lot of times on the show before, but it has brands including Airwick, Harpic, Vanish, Durex, Cillit Bang, Gaviscon, Nurofen. It's got more orientated towards cleaning, consumer health, and it does have a big nutrition business, which has been challenging and was very expensive to buy when it did acquire it. Might be going back as far as sort of 2016, which it paid an awful lot for. Anyway, if we go into the statement, then they reported third quarter net revenue of £3.5 billion, down 0.5% on a like-for-like basis. Within that, volumes dropped by 1.4%, which was actually better than the 3.1% that was expected, with pricing giving a 0.9% positive offset. Hygiene and health delivered both volume and price growth, led by Lysol, Gaviscon, Durex, BMS, and the nutrition business saw like-for-like sales down 17.4% as supply to customers was impacted by the Mount Vernon tornado, but that wasn't actually as bad as it was expected to be. And full year targets are unchanged, pointing to like-for-like net revenue growth of between 1 and 3%. And the shares were up around 3.5% in early trading. In terms of the valuation, Reckitt has a market cap of £33 billion and trades at 14.3 times forward earnings, compared with a 10-year average of 19.4, and it has a prospective dividend yield of 4.4%. I think you touched on it earlier, Sam. The brands are decent. They're not as strong as Unilever's. I think the results bit disappointing. Well, they are disappointing. The nutrition business, it was helped by strong comparators from last year, where there were supply issues from some competitors. So perhaps that's not quite as bad as it looks. But certainly they paid huge amounts for the formula business a few years back. It's being offloaded, but its goodness, has it had an impact on it? I think the business has been badly run. It wasn't helped by the chief executive who had been brought in for the turnaround, leaving and going to Starbucks, where he's actually subsequently sacked. But it's been in a bit of turmoil. It has been underperforming. And I think the difficulty is that there isn't a clear turnaround program going on with it. It's got some lawsuits going on in the States over Mead Johnson and complications which were allegedly due to their infant baby formula. So I think that's a headache. And at the current valuation, 14.3, I don't think it's probably reflecting those difficulties enough. Although some people would say, well, that's, an opportunity to look at it at that 10-year average. But I don't think it's been performing well over those, in those 10 years. So it's one that I sold last year and I'd be staying well clear of.
I'd largely agree. I don't think the brands are terrible, and there are some excellent brands in there. So, for example, Durex, I think that's a fantastic brand. Gaviscon's a pretty good brand, but then you go outside of sort of those sort of healthcare-y ones, and it's not got loads of other stuff. I don't think I'd want to pay 14 times earnings for it. And I think you've touched on it, but you strip out the pandemic, they've not really done a huge amount in the past 10 years. So I'm not sure what they've done to justify that 10-year average, actually. Yes, it's not a terrible business, but the thing is with consumer goods, you have so much choice. I think now, even in the UK market, obviously you've got Unilever, you've got Reckitt, you've got PZ Cussons, you've got Haleon. There's a huge amount of choice in terms of you've got some really, really good options to buy some really, really high quality brands on the UK market. And given the way it's been performing, I'd probably buy Haleon before I bought Reckitt, actually. What about you?
I probably would, actually. It'll be interesting to cover Haleon next. Well, I don't think necessarily next time, but when they next come out with a trading statement and just see how that's doing, because that has been performing very well from what we thought was a bit of a disappointing business, and it had been loaded with quite a bit of debt from Glaxo. So I think that will certainly be interesting. Haleon certainly looks like it's well run.
Yeah, I think for me, I don't think I'd really be interested in Reckitt, given how many alternatives you have available in the UK, and I don't really see what changes things. What do they do to turn it around? I don't really, because part of it is just kind of going to rise and fall with the UK cleaning market. They don't have that diversification of brands that, for example, Unilever does, I don't think.
Well, yeah, I think the answer before was that you purchase a big formula business and that you've got the grow. Well, growing population in China, and that with the growth of the population in China, but more babies, more formula. That was the growth strategy. Hence why they paid so much for the formula business. And then you saw, unfortunately for Reckitt, growth rates in China moderating, and then it looked far too much for what they paid. So the strategy that was the big strategy. It failed, and I haven't seen anything coming out of it really since. You had the pandemic, as you mentioned, and it looked like that might be, the longer term, the cleaning business with brands like Dettol, fantastic. But the
Everyone
pandemic is
stopped washing their hands now, haven't they?
well, exactly. And there was always the discussion about, was this going to be a longer term trend? Would it continue for, another 10 years or 15 years after the pandemic? And it was much shorter lived than, the optimists at Reckitt would have had you believe.
But yeah, I think for me, you're paying 14 times earnings, but you're paying 14 times earnings, and I'd argue you're not expecting any growth. I'm not even sure
Yeah,
they can get back to where they were because I don't know what the strategy is. You had
yeah,
talked about Unilever with the core brands. I don't agree with spinning out the ice cream, but I can kind of see the logic of why they're doing it. Although I would rather have a lower margin business that's growing at 10% a year and just make a
yeah.
bit smaller margins on it. But at least there is a strategy there. You've seen that with the new management coming in. You can see it, for example, with Haleon as well. You can see the management since they've had full control of that. There is a strategy in place. I don't really get that sense with Reckitt. I just don't know what the plan is other than hope for another pandemic.
Yes, that's right. Fine. Okay, shall we move on from Reckitt then?
Yes, so we're now going from our second consumer goods company to our second bank of the week. And this time it is Barclays, who've also come out with a Q3 trading statement. So they reported a 5% rise in third quarter income to 6.6 billion. Performance broadly positive across divisions, with the UK and investment banking arms growing, offset by US consumer, where exchange rates were a drag. Profits before tax rose 18% to 2.2 billion, which was better than the 2 billion expected. The beat was driven by better income than expected and lower impairments, which came in at 374 million compared to 452 million expected. The CET1 ratio, a key measure of capital levels, moved from 13.6 to 13.8%. That's within the 13 to 14% target range, as with NatWest. Guidance for net interest income, excluding investment bank and head office, has been improved from 11 billion to greater than 11 billion, and the shares rose 2.8% in early trading. It's worth mentioning that Barclays is probably a better diversified business than NatWest that we covered earlier, with the UK only one part of the global revenues, and it's also got one of the largest global investment banks, whereas NatWest doesn't, and it also has a sizable US credit card business. In terms of valuation, the business trades at a price to book of 0.52, and that compares to a 10-year average of 0.51. The prospective yield is 3.8%, and that compares to a 10-year average of 4.2%. And the PE is 8.73. So again, I actually think, apart from the fact that I've explained it's a bit more diversified and we've mentioned the investment banking arm, in terms of the core UK banking business, I could have read the NatWest results out, and I don't think you would have noticed. They're virtually the same. I think it shows what a cyclical business it is, how hard it is to have anything resembling a moat. Also, even the share price. So Barclays are up 87% in the past 12 months. That compares to 103% for NatWest. So NatWest has outperformed it, but the sector in general has done very, very well. I'd have the exact same concerns that I had with NatWest, so I won't repeat them. But yeah, just for me, it's not a business I'd be interested in, partly because I just find it too difficult to understand. What about you, John? How do you feel about these results compared to your NatWest ones?
Yeah, well, they're not that different. I get the diversification argument in terms of the revenue stream, and I guess that's one of the things that people would make the bull case for Barclays is it's got that investment arm. Although these results do seem very similar, I think historically I had gone with Lloyd's and I suppose NatWest, the same sort of thing, more on the valuation basis. It was retail banking, sort of pure and simple. They had large government ownership. Obviously, Lloyd's is now fully private and NatWest is going that way, although it's not there yet. I know Jeremy Hunt, when he was the Chancellor, had talked about a sort of Telsid style sale. That's now not going to happen. So I'm not entirely sure when it's going to be fully free of government ownership, but they had been significantly cheaper. I think NatWest had had a lot of legacy issues again, which over the last 10 years it was seeking to resolve, and it was probably the worst governance of the UK banks in 2008. So you'd had that discount, and I think that's probably now going. What did you say the valuation of Barclays was?
So it's a bit pricier. It's 8.75x earnings, whereas
Yeah.
NatWest is more like 7.5.
Yeah, I think that valuation has closed though over the years, and I think that's showing that the reforms at NatWest have overall. I know there's the Nigel Farage and debanking, but overall gone in the in the right direction. Part of my legacy portfolio, I haven't fully decided, and it's something I need to think about with the banks in my the bank in my portfolio, and I think I'll probably reflect on that more after this episode. I don't have much more to add, to be honest. I think looking at them now, it's very much in the too hard pile.
Should move on to a business that's much easier to understand.
Yeah, so the third and biggest consumer goods company of the week, Coca-Cola, and that is Coca-Cola Daddy Coke, as it were, listed in the States. They had their third quarter results out with third quarter underlying revenue growing by 9% organically to $11.9 billion, ignoring currency impacts. And this was ahead of market expectations, with growth driven by higher prices, which more than offset a 2% decline in volumes. Underlying operating profit rose by 14% to $3.7 billion as a result of the uplift in revenue and positive impact of refranchising bottling operations. And underlying free cash flow fell from $7.9 billion to $7.6 billion over the first 9 months of the year, largely due to increased tax payments. Net debt came in at $25.9 billion, up from $23.8 billion at the beginning of the year. The group now expects to deliver full-year organic revenue growth of 10%, which is at the top end of its prior guidance range. And the shares were down around 1% in early trading. In terms of valuation, Coke has a market cap of $288 billion and trades at 23 times forward earnings, compared with a 10-year average of 22.5, and has a prospective dividend yield of just under 3%. I mean, I think these results do show the incredible pricing power of Coke, and probably the strongest brand in the world. And that's not to mention that it also has other strong brands, including Fanta, Innocent Smoothies. It's got a whole range. And it also, as we covered from a UK perspective, acquired Costa from Whitbread a few years ago. And I think that's, potentially interesting for Coke. We both discussed it before in terms of Costa trying to break out of the UK market, where it's largely saturated, and go into the States. And you think without the backing of a company like Coke, it would be very difficult to compete with the likes of Starbucks. I think that potentially gives a little bit more of an area for growth. Although, when you look at the size of Costa and the size of Coca-Cola and its other brands, I'm sure that's still going to be small. But I think that is something that's potentially quite interesting. I think it's also, positive or part of the bull case, I guess, for investing in Coke, that it's slightly different from some of the other drinks makers, in that it partners with the Coca-Cola partners, like Coca-Cola HBC, for example, local bottling companies, which does keep down its costs and allows for it to retain those huge margins, which are about 60%. So absolutely huge. I think valuation-wise, that's always difficult. It's pretty pricey at 23 times forward earnings, but for the quality of the brands, they're never going to be that cheap, and it does keep putting up fantastic numbers. Bit disappointing that volumes have declined, but I think when you see that brand and they're able to increase revenue as they have done, it's a testament to that. Sam, what are your thoughts on these results from Coke?
I think they're fantastic. I didn't expect them to be that good. So if we just compare them to Pepsi, which we did cover a couple of weeks ago, but Coca-Cola's revenue is up 9%. That compares to 1.3% for Pepsi. underlying operating profit rose 14%. That compares to 6% for Pepsi, and Pepsi's was really only 6% because of cost controls, whereas Coca-Cola's really come from growth, which I'd definitely prefer. In terms of valuation, it's a bit pricier, P of 23 compared to 19.6, but it's not that much pricier, 15% premium. Results are a lot better. I wouldn't expect it to do this consistently because it's in a market that's pretty saturated. However, like you say, there might be opportunity with Costa. But yeah, for a business of this size in such a saturated market, I think this is as good a set of results as you could ever hope to see as a shareholder, really. I don't think there's really anything to criticise.
Would you ever be interested? Oh, well, it's a silly question because I know you're going to say at the right price, but
yeah,
at the current price, would you be interested?
No, not at 23
Okay.
times earnings.
Right.
I think it's not going to grow 9%. This is a
Yeah.
one-off. It's going to drop back down. I don't know to what level, but you'd hope slightly above inflation. But if this business can grow 4 or 5% a year, assuming 2 or 3% inflation, I think that's a very good result for a business of this size. Maybe you can get up to 5 or 6% if you factor in Costa. Costa is such a small part of the business that,
Yeah.
and unlike Pepsi, it's not got this portfolio of fantastic snack brands either. I know it's got Innocent and stuff like that, but it's mainly drinks. So for me, if I think in the best case scenario, this business is going to go 5-6% a year, even though, like you say, it's one of the best brands in the world, I don't think I'd pay 23 times earnings for it.
Fine. Okay. Leads us nicely on to your pick of the week. What would be a top choice and what would come last?
So top choice is, I think, quite easy this week. I think it would actually be Unilever by quite a distance. I think
Okay.
Coke's probably the best business, but I think when you factor in valuation and also growth potential, probably Unilever. Least favourite, I think it's a toss-up between NatWest and Barclays. I do view them as essentially being the same, so I'll probably put them joint bottom because of that. But that's just because of the industry. Both of them had very good results. What about you?
Yeah, I would probably, without being boring, agree with you on Unilever, and I think it's fair enough because I do own Unilever and more happily now. In terms of last, I would probably go with Bunzl in terms of the industry, but the banks are there in terms of uncertainty, and I'm not sure that they're going to make up part of my portfolio longer term.
Right, I think that's everything in that case.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.